Your advisor probably sent you a note about the 2026 tax brackets. Good news, right? Brackets went up, inflation adjustment, routine stuff. Here's what they didn't put in front of you. Lower earners got a 4% adjustment. You, if you're earning north of $250,000 a year, you got a 2.3% adjustment. What was the official CPI last year? It was 2.7. And if your cost of living looks more like private school, property taxes, healthcare premiums, your personal inflation rate is probably double that. So your brackets moved up 2.3%, while your actual cost of living moved up 5 or 6%. So guess what? That's not a tax cut. That is a slow bleed dressed up as a headline. And that's actually the smallest of 3 changes hitting high income earners in 2026. The other 2, your advisor probably hasn't mentioned them yet either. The new tax law, officially called the One Big Beautiful Bill Act, I didn't name it, created a 2-tier inflation adjustment for the first time.
This is not a big, beautiful bill at all. That is why I moved on the floor to strike the title. It is now called the Act.
The bottom 2 brackets got bumped 4%. Everything above that, 2.3%. The Tax Foundation's Director of Policy Analysis, Garrett Watson, called brackets adjustments a lagging measure of inflation. They're based on last year's numbers, not this year's prices. So you're already behind before you file. But that's not even the expensive part. Starting January 1st, 2026, there's a new rule called the 237th rule. Schwab's own tax team described it this way. It caps the maximum you may deduct at 35 cents for every dollar of itemized deduction. If you're in the 37th percent tax bracket, so let's run the numbers. 100,000 in deductions in 2025, that saves you 37,000 in taxes. In 2026, same deductions, that only saves you 35,000. That's $2,000 gone every year. And this rule is permanent. It doesn't sunset. Over 20 years, that's $40,000 in lost tax benefits at a minimum, or just that one provision. Now the third piece, this is the one that really stings. You heard the SALT deductions went from $10,000 to $40,000. That was the headline. What did the headline leave out? It phases out starting at $505,000 in total income for 2026. 30 cents of every dollar over that threshold gets clawed back. So if you're a married couple earning $700,000 in New Jersey or California, your SALT deduction isn't $40,000, it's now $10,000. Your neighbor earning $450,000, they get the full amount. Let me stack all 3 together on a single household. $800,000 in income, high tax state, 1% advisor fee on a $1 million portfolio, bracket creep costs roughly $3,000 a year. The 237th rule costs another $2,000. The SALT phase out costs $11,000. And the advisor fee drags $10,000 plus. That's $26,000 a year in combined erosion. Over 20 years, north of $500,000. And the headline said you got a tax cut. Somebody got a tax cut. The math just says it wasn't you. And look, if this is getting complicated, don't worry about it. It took me years to figure this stuff out. I have an unhealthy habit of reading IRS fine print that my wife is not thrilled about. But here's what you can do. You can share this video with your financial advisor and your CPA and just say, hey, walk me through this. Is this affecting me? Let them run the numbers for your specific situation. That's literally their job. That is what they're there for. Let me give you an idea of what this looks like. A couple I was talking to recently, their advisor sent them a note in October saying the 2026 brackets were good news. 3 months later, their CPA runs the actual projection, $12,000 more in federal tax than in 2025 for the same income, same deductions, $12,000 in the wrong direction. You see, what's going on is high income earners over that $500,000 mark, you guys are the forgotten people. You have a target on your back. The current administration is doing everything they can to benefit people who make under $150,000. Now, whether that's right, wrong, or indifferent, that's not my job to say. I'm just giving you guys the facts. So below 150, getting benefits. 150 to $500,000, getting some benefits. But $500,000 and over, you guys are the forgotten people. Nobody cares about you. You guys don't have a voting block, and you guys just have cash that the government feels like they can take. So here's how. Combined income of around $600,000. This guy's a VP at a tech company. She has a consulting practice. They live in Westchester, New York. They have 2 kids in college. They have about 1.6 managed by an advisor, charging just under 1%. At $600,000 in modified adjusted gross income, Maggie, drops their deduction from $40,000 to around $11,500. The 237th rule shaves another $4,600. The bracket adjustment didn't keep pace with what things actually cost. Their advisor never modeled any of it for them. Not out of malice, the advisor's job is managing the portfolio, not running tax projections. But the gap between what the advisor covers and what the tax code actually does to their money, that's where the $12,000 a year lives. So what do people who manage serious money do differently when this tax code shifts like this? First, and this is the most actionable one right now, they're restructuring income timing. Roth conversions side specifically to stay below the 37% tax bracket threshold. That avoids the 237th rule entirely, it avoids the SALT phase out, and it moves money into a vehicle that grows tax-free for the rest of their lives. Second, and this is the allocation piece, they're shifting portions of taxable portfolios into vehicles with different tax profiles. Real assets with depreciation benefits, private credit generating income categorized different than ordinary income, structures where the tax code works in your favor instead of against it. And here's what I mean by that. $1 million in a traditional stock and bond portfolio generating 7% in a taxable account at a 37% marginal rate keeps roughly 4.5% after federal tax. $1 million allocated in depreciation eligible real estate can generate comparable or better cash flow while showing a tax loss on paper. That's because the IRS lets you deduct the wear and tear on the property, depreciation, even though the property may actually be appreciating and generating rent. Your tax return says you lost money. Your bank account says you didn't. The loss offsets other income. It can push your taxable income below the 37% threshold, which simultaneously kills the 237th rule, reopens the SALT deduction, and drops your effective tax rate. And some of these moves started last year. Family offices were accelerating charitable giving into 2025 before the new 0.5% AGI floor kicked in. If you miss that window, the first two strategies still apply. Now, alternatives come with trade-offs, liquidity, complexity, and real due diligence, but the math is the math. And increasingly, accredited investors have access to vehicles that used to require $25 million to get through the door. So here's what this comes down to. You now have two choices with the 2026 tax code. Absorb it, keep the current structure, pay the extra $26,000 a year, and hope your portfolio outruns it. Or restructuring around it. Use the same tools the code makes available and position your income below the thresholds where these three provisions bite. That's not advice, that's arithmetic, and it's worth running before your next quarterly review. Now, I mentioned depreciation eligible real estate earlier, how they generate cash flow while producing a tax loss on paper, how that loss can push you below the 37% threshold, which takes the 237th rule off the table and reopens the SALT deduction. The question I get most is, okay, I see the math, but what does it actually look like? Because I'm not gonna be the one managing contractors, sitting in houses like this on the one behind me, and taking tenant calls at midnight. Fair. And that's why I pulled out this next video right here for you to watch next. It walks you through the actual mechanism, how these assets get acquired, how the depreciation works on your return, what the financing looks like right now, and why the numbers work even at today's rates when most people assume they don't. This isn't advice for your specific portfolio. But if you just watch this whole video and your next thought is, what do I actually do with this? Right here. This is the video to watch.